Dr. Lowe, I just wanted to clarify some of the comments that you've made today and recently about inflation. You said today in answers to questions that housing and energy are out there as costs that are contributing to inflation. You sort of used words to the effect that high inflation will be with us for years. I think last week you spoke about inflation starting to taper off. You've obviously forecast a peak in December of CPI at 8%, and then inflation starting to tail off a bit. Can you talk to us a bit more about some of the factors that you see contributing to a decline in inflation over the next couple of years? And then I guess also just clarify where you see it going in the next year or two.
Yeah, well, thank you. If I said inflation is going to be high for years, I should have said for some years, not indefinitely. Our job is to make sure that it does come back to the 2 to 3% target over time. So we're expecting inflation to peak at 8% later this year, and then next year headline inflation to be 4 3/4, and then in 2024 just a bit above 3, and then as we go out back below 3. There are three things that underlie the expected reduction in inflation. The first is the resolution of the supply side problems in the global markets. We're seeing in a lot of industries shipping times come down, delivery times shortening, and the disruptions to the supply chains, which have been so prevalent for the last 2 years, they're gradually being resolved, and the prices of many goods are no longer rising quickly. In fact, some are actually falling now. They rose too much when demand was very strong and supply was weak, and now they're coming down. So that is going to help. The second thing that's going to help is commodity prices have stabilised and actually come back down again. Most commodity prices are back to where they were in January before Russia invaded Ukraine. So the price of oil in global markets is kind of in the low 80s again, where it had got up to almost 120. So commodity prices have stabilised, and as commodity prices stabilise and some fall, that eventually flows through the cost of production, and so you don't get the big increases. Because remember, inflation is the rate of change of prices. So if commodity prices are actually coming down, then the rate of change of prices for some things could go negative. So that will help. And the third thing that will help is the increase in interest rates. That is going to slow aggregate demand in the economy. That's the intention. And slower growth in aggregate demand will mean less pressure on capacity. So less growth in aggregate demand, the supply side fixing itself up in global markets, and lower commodity prices together will bring inflation down. And the two counters to that are the ones that I've already referred to, are cost of energy and rents. Rents are one of the really large components in the CPI, and they're now starting to move more quickly. So the other things are helping, but rents and energy are going to be working in the other direction. I think the other general point that I've been making over recent times, and other central banks are making the same point, is the return of inflation to target will be smoother if growth in labour costs doesn't accelerate too much more. Aggregate growth in labour costs at the moment in Australia is consistent with inflation returning to target. So right at the moment, I don't think we've got a problem. Many other countries do. The US, UK, Canada, wage growth 5.5%, 6% at the aggregate level. That's not consistent. Those rates of increase in labour costs aren't consistent with inflation returning to target. The rate of growth in labour costs here is still consistent with inflation returning to target. So that's an important issue for us to watch, what happens there.
So those comments have attracted some attention. You're suggesting that with inflation running or projected to run at 8% in December, that you wouldn't want to see real wages of 8% in an effort to at nominal
Yeah,
wages. Nominal
go.
wages at 8% in an effort for sort of real wages to keep up. Is that that's the concern that you're pointing to,
Well,
as opposed to, for example, people's nominal wages sort of starting to pick up in the sort of range that used to be referred to as the RBA sort of target range for wages?
Yeah, for many years, I'd been complaining that wage growth was too low. We were undershooting our inflation target, as I said in response to Senator McKim's question. Wage growth was too low for too long, and I'd been giving public talks and various appearances before the House Economics Committee, had been saying, look, this is a problem we need to address. So we're very glad to see a pick-up in nominal wages growth. And the aggregates at the moment are not particularly concerning. So that's good news. What I've been doing recently is flagging the risk that we could go too far. I don't think we're going to, but we could. And I just invite you to think about the consequences of aggregate wage growth this year being 8%. This is kind of the hypothetical that you just raised. So let's say nominal wage growth was 8%.
Seems very hypothetical.
It is very hypothetical. But in many countries, I'm saying wage growth is north of 6%. So it has happened in other countries where the labour market has got very tight and firms desperate to hire workers are paying much bigger increases. So and I said it's very hypothetical, but it's sensible for us to at least work through this and to draw attention to this risk. If that were to happen, if wage growth was 7 or 8%, so real wages were maintained, then inflation next year would be 6 or 7% plus or minus a bit. And then if workers had to keep real wages constant, wages 6 or 7%, it just goes on. And we were in this world in the 1970s and it worked out really badly. I don't think we're going to return to it, but in the meetings of central banks that I go to, and I talk to the governors of the other central banks a lot, this is something that everyone's talking about, this possible risk. Australia's in a better position than most others. We're not seeing that risk manifest, and we best not. And it's a really hard, I understand this is a really hard message for people, to say inflation's 8 and wages maybe 3 or 4. So your real wage is actually declining this year. And so it's a hard message for everyone, but the alternative is even more difficult.
So your November statement put CPI back at 3% around December 24.
Yep.
And you've spoken about the supply side challenges on energy and housing, and you've talked about the factors that may see that decline from 8% down to 3%. So in that sort of period of the next couple of years, you're saying that you're generally confident that inflation will decline down to that sort of level over the next couple of years.
Well, that's our job to make sure that happens. I just kind of highlight a couple of other facts for you. In the last year, the cost of constructing a new home in Australia went up more than 20%. That added almost 2 percentage points to inflation. I don't know what the cost of constructing a new home in the next year is going to go up, but surely it won't be 20% and maybe 4 or 5, or maybe even some construction costs could come down a bit. So that 2 percentage point contribution goes to something just a fraction of that. And up until the September quarter, the price of petrol had gone up 37%. So the year to September next year, I expect the price of petrol probably be lower. Who knows? But it's not going to be up another 30%. So just take those two things out and inflation comes down, and fixing up the other supply side problems in global goods markets and reduced demand, inflation comes down as well. And as long as we manage the kind of the price and wage setting dynamics okay, then we have a better chance than almost any other advanced economy of having a fairly soft landing. And it's not guaranteed, but from where I sit today, I think we've got a better chance than most other countries of pulling it off, because the wage outcomes are still okay and the supply side here is being addressed.
So again, just to try to sort of clarify your comments around wages, because there's been a bit of discussion today about how things you say then get explained in the world.
Yeah.
You know, it's your job and hope and expectation that inflation will drop off over the next couple of years to hit that sort of, 3% level.
Yeah.
You don't want to see sort of 6 to 8% sort of real wages as that occurs, because you think that will have an impact on inflation, a further impact on inflation. But when you look towards the sort of December 24, 3% inflation figure, generally the RBA's sort of target position has been for there to be real wage increases.
Yep.
So when we look forward over the next couple of years, is it the case that you want to see sort of sustained nominal wage increases so that as we get through this period, in the next couple of years, we can get back to that sort of target range of inflation and wages?
Of course, we want to see real wages growing. That's, people get better living standards and they have more opportunity if their real wages are growing. But we've got to be realistic. What's achievable when inflation's the highest rate in 30 years? And as difficult as it is, we're going to get better outcomes over the medium term by accepting some modest reduction in real wages this year. And then by the time we get into 2024, if inflation's back to 3, our expectation is that growth in labour costs will be around 4, and that's probably okay. So real wages, real incomes of people will be rising again as we go into 2024. But if we seek to have no reduction in real wages this year, we'll have to have higher interest rates later on. Senator McKim asked me before about the right response to supply shocks, and I said, well, as long as they can wash through the system without anything changes, then you don't need to have a monetary policy response. But if everything changes in response to a supply shock, including wage and price setting behaviour, then you've got to have a monetary policy response, and that means weaker growth later on. So as difficult as it is, I think the best outcome for the country is for wages growth to pick up as it has, but not to go too much further, and then let these supply side problems fix themselves up and inflation will come down, and once again we can come back to growth in real incomes for people. I think that's achievable. It's not achievable in many other countries, I think, because they've already gone past the point where wage growth is consistent with inflation target. We're still there. So I'm encouraged by the position we're in, and what I've been drawing attention to are the risks. I'm not saying those risks are going to eventuate, or even there's a high likelihood to eventuate, but I feel in my job I have to draw attention to the risks, as unpleasant that is, and by drawing attention to them, the hope is that we can avoid them.
Are those risks diminishing or increasing?
Yeah.
I don't know.
Senator Smith snuck a question in there, and I also neglected to put the timer on myself, but I suspect my time is up, and we're going to Senator Canavan.
Thank you.